Hey everyone, welcome back. We're diving into some pretty interesting discussions happening right now at the Federal Reserve, specifically about President Trump's economic policies, as of February 2025. So, we're already into his second term here.
Yeah, that's right. And we've got some pretty compelling analysis here about uh, where these policies could potentially lead. And our goal today is to really break these concerns down for you guys to kind of look at what the stakes are and how the Fed is sort of navigating this economic landscape we're in. And we want to make sure to keep it nice and clear for everyone listening.
So I think a good place to start is with something that was really central to the Trump administration's economic approach, and that is trade policies,
Mm.
specifically the use of tariffs. I mean, there was a lot of talk about using tariffs, right,
Yes.
on imported goods
Yeah.
from a whole bunch of different countries. And the main idea, as I recall, was to boost American manufacturing and shrink that trade deficit.
Exactly. The thinking was that by making imported goods more expensive through these tariffs, it would give domestic producers a bit of an advantage. But the analysis we've been looking at suggests that, in reality, things have played out a bit differently, at least in a few key sectors. So one thing we've observed is that these tariffs have generally led to higher costs, for American businesses that rely on imported components or materials for their production. And as you can imagine, a lot of these increased costs end up being passed along to the consumer. And what's really important to consider here is that these tariff-driven price increases, they tend to hit lower income households particularly hard because they spend a larger chunk of their income on those essential goods that are often targeted by these tariffs. So it raises some important questions about fairness and the broader societal effects of these types of policies.
So it seems like one of the direct consequences of these tariffs has been um, to add to this inflationary pressure we've been experiencing, right? Because more expensive imports mean, well, higher prices at the checkout. It seems like a pretty straightforward connection.
Right. And when you layer those tariff-driven price increases on top of, other government actions that might be stimulating demand across the economy, that upward pressure on prices can really become pretty substantial. And the fact that the consumer price index hit 2.8% back in February 2025, I think that's a key data point to consider.
Right, because the Federal Reserve, as we all know, is aiming for a long-term inflation target of about 2%. So 2.8%, that's not just a little blip, it's a noticeable difference. So what does this mean for the folks over at the Fed who are, trying to keep the economy on track? What kind of challenges does this present?
Well, it puts them in a really tricky spot. See, the Fed has this dual mandate, right? They're supposed to promote maximum employment and keep prices stable. So when inflation starts creeping up like this, the actions they might need to take to bring it back down, well, those actions can sometimes cool the economy down a bit, and then that can, potentially impact employment levels. So they have to really weigh these two crucial objectives very carefully. Because on the one hand, rising inflation erodes purchasing power, right? People's money just doesn't go as far. But on the other hand, the typical tool to fight inflation, which is raising those interest rates, well, that can sometimes lead to slower economic growth. And historically, the Fed has often faced this trade-off. It's called the Phillips curve, where lower unemployment sometimes comes at the cost of higher inflation, and vice versa. So navigating that delicate balance, it requires a lot of careful calibration with their monetary policy tools.
So we've got these trade tensions causing ripples in the economy. We've got inflation on the rise, which seems to be at least partly tied to those policies. And now another big topic that's come up in our research is the potential impact of the administration's policies on the very institution that's supposed to manage inflation, the Federal Reserve itself. So why is this whole idea of the Fed's independence such a hot topic right now? What's driving this discussion?
Yeah, this is where things start to get really interesting and potentially a bit concerning for, the long-term stability of our financial system. We're seeing reports, analysis, discussing proposals that could, significantly limit the Fed's autonomy. Things like allowing the president to directly set interest rates, the possibility of removing the Fed chair before their term is up, and even, making the Fed's operational decisions subject to oversight from the Office of Management and Budget. It's kind of like, think of it like a referee in a sports game. They have to be impartial, they have to follow the rules, even if one of the teams, and in this case that would be the political administration, really disagrees with the call. If you start questioning or undermining the referee's authority all the time, the game can get pretty chaotic, pretty unfair. And in our case, well, that could mean a chaotic, unstable economy.
Yeah, those sound like some pretty fundamental changes to how the Fed operates.
Yeah.
So why is this independence such a big deal in the first place? What's the main argument for, keeping the Fed at arm's length from direct political influence?
The basic idea is that the Fed needs to be able to make decisions based purely on, objective economic data, on analysis, not on political whims or the immediate needs of whatever administration happens to be in power. Just imagine if interest rates were being set, based on election cycles or on the current political priorities of the moment. You could end up with policies that aren't in the best long-term interest of the economy. You could set the stage for, these big boom and bust cycles. So having the Fed be independent allows them to take a longer view, to make decisions that might be unpopular in the short term, but are necessary to maintain economic stability for everyone.
So we've got these trade tensions making waves, we've got rising inflation, and now we've got potential challenges to the Fed's ability to act independently. It sounds like a recipe for a whole lot of economic uncertainty, and that brings us to the growing concerns about a possible recession. Are all these factors kind of feeding into those fears?
They're absolutely interconnected. See, if we zoom out and look at the bigger picture, these aren't isolated events. These trade tensions, they create this climate of uncertainty for businesses, which can make them hesitant to invest or hire more people. Inflation eats away at the purchasing power of consumers, leading them to maybe cut back on their spending. And then, any perception that the Fed's independence is being eroded, that can spook investors and really destabilize financial markets. And what we're seeing is that economic analysts are actually revising their growth projections downwards. Some are even predicting a contraction in GDP, in the first quarter of 2025.
And we've also seen some increased volatility in the stock market, right? Is that a sign of this broader anxiety, this uncertainty about where the economy is headed?
Yeah, exactly. The stock market often acts as a sort of, a preview of investor sentiment. It's forward-looking. And this uncertainty surrounding the administration's economic policies, combined with the ongoing concerns about inflation and these worries about the Fed's ability to respond effectively, all of that contributes to this increased volatility. It's basically investors trying to price in all these different potential risks. So the Fed is really in a tough spot here, trying to navigate all of this uncertainty and, keep the economy stable.
So given everything we've discussed so far, how's the Fed actually been reacting to all this? What kind of monetary policy approach has they been taking?
Well, what's really interesting is the cautious wait-and-see approach that the Federal Open Market Committee, the FOMC, has been signaling. They've kept the federal funds rate in the range of 4.25% to 4.5% in their recent meetings. Now, that federal funds rate, that's basically the target rate that banks charge each other for, very short-term loans, overnight lending of reserves. And it's a key lever the Fed uses to influence borrowing costs throughout the economy. When this rate goes up, it generally becomes more expensive for businesses and consumers to borrow. So by holding rates steady, the Fed is signaling that they're carefully watching how these policies are playing out in the real economy before making any further moves on interest rates.
It sounds like they're, gathering more data, trying to get a clearer picture before committing to a specific course of action. But you mentioned earlier that there are limits to what monetary policy can actually achieve, especially if the Fed's independence is potentially being compromised, and if fiscal policies are kind of pushing things in a different direction. Could you unpack that a little bit for us? Explain that interplay.
Sure. So think of it this way. You've got monetary policy, which is how the Fed manages the supply of money and credit in the economy, mainly through things like interest rates. And then you've got fiscal policy, which is controlled by the government, through its decisions on spending and taxes. Ideally, these two should be working together, right, in a coordinated way to reach those broader economic goals. But if fiscal policies are really contributing to these inflationary pressures, the Fed might have to tighten monetary policy quite a bit, meaning raising those interest rates more aggressively to counteract those effects. However, if the Fed's independence is limited, their ability to make those necessary, potentially drastic adjustments could be hampered by political factors. And on top of that, if the government is also pursuing policies that could, destabilize the economy in other ways, the Fed's usual monetary policy tools might not be as effective at restoring balance.
And it's not just about what's happening within the U.S. economy, right? These policies also have implications on the global stage. So how are international markets and investors viewing all of this, all this uncertainty?
That's a crucial point. This uncertainty stemming from President Trump's economic policies, it reaches far beyond U.S. borders. Global investors are watching this very closely. And how they perceive the strength and stability of the U.S. economy, well, that directly shapes their investment decisions. It affects capital flows. And we're seeing signs that bond investors, anticipating a potential slowdown in U.S. economic growth, have started adjusting their portfolios. They're reducing their exposure to riskier assets, which reflects a broader concern about the direction of U.S. economic policy. policy and the potential for, for what we were talking about earlier, a policy-induced weakening of the economy, this shift toward a more a more defensive investment approach globally, it really highlights how interconnected our international financial markets are. And it underscores the fact that domestic policy choices can have huge ripple effects throughout the global financial system.
So to kind of sum up where we are, it sounds the Federal Reserve is grappling with several major interconnected concerns, all tied to the direction of the administration's economic policy. We've talked about the concrete effects of those trade policies, the ongoing challenge of elevated inflation, and maybe most importantly, the critical need to protect the Fed's independence to make sure that policy decisions are grounded in, economic realities, not political convenience. That independence, it's really a cornerstone of sound economic management.
You've got it. That's precisely the core challenge for the Fed right now. It's this balancing act, right? Trying to navigate this complex and somewhat unpredictable environment while striving to fulfill their dual mandate of maximum employment and stable prices. It takes careful judgment. It takes a real commitment to making decisions based on the data.
And it really underscores why the Fed's autonomy is such a vital part of a healthy economy. It's about making sure those decisions that impact everyone's financial well-being, that those decisions are made with a long-term perspective, guided by economic data and the goal of stability, not by short-term political pressures or agendas.
Absolutely. Couldn't have said it better myself.
So, thinking back on everything we've talked about today, these trade policies, inflationary pressures, the questions about the Fed's independence, all the resulting uncertainty in the economy, it really paints a picture of this, complex, constantly shifting economic landscape. It really gets you thinking. I mean, considering all these potential headwinds, all these challenges facing the economy, what specific economic indicators would you be watching most closely in the coming months? To really gauge the true impact of these policies as things continue to develop. What kind of data points would signal to you that the economic trajectory we've been discussing, that it's actually shifting in a significant way?
That is a great question.
Thanks for listening, everyone. We'll see you next time.
See you then.
If you found this discussion informative, please like, subscribe, and share this channel to get daily discussions on a current economic topic.